Hi, morning everyone. Welcome to this morning's webinar. If you can hear me and see something on the screen, please type something in the chat box. Okay, thanks. So, Tara here. This morning we'll be sharing on updates for CapitaLand, Health Management International, China Every Bright Water, CNMC Gold Mine, Asian Pay Television Trust, as well as our China Weekly Musings, US Weekly Musings, and Phillip Weekly Musings. For CapitaLand, they released their third quarter results last week. Year-on-year revenue has been down. This is mainly because there were lower contributions from their developments in Singapore and China, which were mitigated by higher rental revenue from new properties that they acquired, and as well as the consolidation of CMT, CRCT, and RCST, Raffles City Singapore Trust, which were consolidated in August last year. So this would be the last quarter that we will see this consolidation effect. And EBIT, there was a slight increase due to portfolio gains from the completion of their 18 retail malls in China. So that's for 3Q, as to date, they actually successfully divested all 20 malls. And there were also some fair value gains from the divestment of 70% stake in Westgate to CMT. And finance costs also up, mainly due to the consolidation of finance costs for the 3 trusts in August. So the positives for this quarter is that you can see that they are actively bumping up their recurring income. Operating PATMI, stripping out the portfolio gains, improved 13.3% year-on-year from the new properties that acquired in Singapore, China, and Germany. And also, you would see that they had a announcement of a pretty big acquisition of Singapore dollars 1.1 billion US multi-family properties, as well as a 70% stake in Tausia, which is Indonesia's leading hotel operator. And outside the quarter, CapitaLand announced its third Raffles City integrated development in China via its Raffles City China Fund, which is a 50-50 JV with GIC. Construction is expected to be completed by June next year, and this would continue to contribute to their fund management platform, which is also part of the recurring income that we've talked about. And year on year, we're also seeing healthy same-store tenant sales growth in Singapore and China. So Singapore, it's about 2.2%. This is in comparison to CMT's 0.5%. So this was actually mainly driven by the strong rental growth, the strong tenant sales growth in their other malls that were owned solely by CapitaLand, such as ION. And for China, we're continuing to see very healthy double-digit growth of 20.9%. And to note that China is the biggest market for the retail. And the negatives would be, as we had also pointed out last quarter, that some of their new launches in the residential launches in China continue to be deferred due to the restrictive cooling measures over there by the government. So there are some restrictions in the selling prices across certain projects. So outlook-wise, the management had explicitly communicated that 4Q18 would be a bumper quarter for the China residential pre-sales. So we're already seeing very healthy take-up rate for those that's already launched in October, which is part of the fourth quarter. So some of the launches saw more than 90% take-up rate. So the Botanica in Xi'an had a 100% take-up rate for its launch in October. And this healthy momentum for all these launched units is expected to persist for the remaining close to 2,000 units in 4Q18. And however, this release would also be subject to the regulatory approval that we mentioned earlier. And also, they continue to actively redeploy their capital, as we can see that they're replenishing their residential land bank in China as well as Singapore. So Singapore, we've all read the news that they had a JV with CDL to acquire the Sengkang Central mixed-use site. So besides this, they have Pearl Bank apartments. So Pearl Bank and Sengkang Central, these are their only two exposure to Singapore resi. And overall, we maintain and accumulate with an adjusted target price of $4. Previously was $4.19. This was due to a change of assumptions following a change of analysts. So I'll move on to Min-Ying.
Right, so moving on to HMI. So for this quarter is their first quarter 19. So the positive for HMI is that the patient load rose. And this quarter is a bit different from the past few quarters because foreign patient load actually grew slower than local patient load. And this was mainly attributable to the weakening rupiah as well as a weakening Malaysian ringgit. And for average bill sizes, it continues to grow. This is mainly due to increasing complexity of surgeries that they're performing on the patients. So for day surgery cases, it continues to lift their margins, and bed occupancy is trending downwards to 59% as compared to first quarter last year of 61%. So note that bed occupancy rate actually tracks the overnight stays, and day surgery cases are built under the outpatient category. So right now, outpatient load makes up 90% of the total patient load. And the reason why that the hospitals, Mahkota and Regency, is still increasing the beds is because at midday, their beds are already overflowed with patients. But as for overnight cases, it's only 59%. So they are still increasing the number of beds in each hospitals. So EBITDA margins continue to improve 50 basis points to 24.9%. So for the negatives for HMI this quarter is that PATMI fell for the first time in 2 years. It dropped by 22% year on year. And this is mainly because of one-off items such as Forex loss. And also StarMed, because it opened in first quarter 19. So there's the gestation cost of 3.1 million in this quarter. And also the accelerated amortization of capitalized expense of 2.5 million, which is for the finance cost. It jumped 173% year on year. And out of the 3.6 million year on year increase for finance cost, 2.5 million is from the capitalized expense that I mentioned just now for the 2.5 million. And this is for the term loan facility that they drew for the consolidation of Mahkota and Regency to 100% ownership. So out of the 3.6 million, the other remaining 1.1 million is because of mortgage financing costs incurred by StarMed. So those who do not know what StarMed is, it's the new hospital that they have started in Singapore at Farrer Park Station. So currently they have, for StarMed, they have the first, they have 4 levels right now, the 5th, 6th, and 7th, then the 8th floor is being rented. But now they have entered into agreements to purchase the 8th floor along with the 1st and the 9th floor. So the reason why they're purchasing more is to have better visibility and also for expansion reasons. So the additional units that they're going to purchase, it's about a total of 10,600 square feet. And for StarMed, they estimate around 2 to 3 years before they break even. So StarMed has already started its operations in first quarter 19. And for the ownership, the HMI management has increased StarMed's ownership to 70% in October. Previously was 62.5. So the remaining 30% will still be owned by the individual doctors. So for Mahkota and Regency, Mahkota is in Malacca and Regency is in Johor. So for Mahkota and Regency, there's not much changes. Expansion for Mahkota's clinical space is still continuing and expected to be completed by early 19. And then progressive and refurbishing of older wards will continue over the next few years. For Regency, the new extension block is in its tender phase right now. So land preparations have already started, and the expansion will see more than 500 beds being added eventually, but the midterm target is around 380 beds. So the extension is expected to finish and commence operations in 2021. So for HMI, we maintain buy with a lower DCF target price of 0.77. And this is because of a more modest growth rate that we factored in, and we lowered our revenue and EBITDA estimates for 2019 to 2020 by 5 and 7% respectively. That's all for HMI. Now I'll pass on to Guangzhi for China Everbright.
So, this one. Okay. Okay. So next is China Everbright Water 3Q results update. So we maintain our buy call with a lower target price of 44 cents. Our previous target price was 53 cents. If we take a look at the results here, both bottom line and top line grow moderately. That was mainly because of the tariff high, as well as some projects commencing operation. So the positives in these quarters were there were 7 wastewater treatment projects secure tariff hike ranging from 10% to 54%, and also 4 extra projects commence operation, and 11 more were under construction and will be operating this quarter and next year. So as of now, more than 90% of the projects already reached grade 1A discharge standard. So some investors may be curious whether there is room for China Everbright to grow organically. So the answer is yes, because some of the governments they expect that the environmental capacity will continue to grow. That means for China Everbright, they need to ramp up or upgrade their existing plants to treat water in a larger capacity. And also recently, the Shandong province revised the wastewater pollution prevention plan and urged the plants to upgrade to raise the standards that is even higher than grade 1A. So moving forward, the group will prioritize on the quality of the existing plants instead of the quantities of M&As. So also this quarter, the collection rate of the receivables improved to 87%, and for the full year's target, it is expected to achieve at least more than 100%. So comparatively, last year they achieved a collection rate of 104%. So the negatives remain the same. The delay of completion of Zhenjiang Spawn City project. So as of 3Q, about 40% of the sub-projects were delayed. So the full completion of this Spawn City project is expected to be next year. So the outlook for Everbright is that the management will continue to grow the wastewater treatment capacity organically by 10% to 20%. And it also will try to explore and expand to regional markets such as Pearl River Delta and Great Bay Area. So next is the CNMC's gold mine 3Q's update. We maintain our buy call with an unchanged target price of 29 cents. So this quarter, the performance continued to improve, mainly due to the ramp-up of production, which partially offset the decrease in average selling price. So now we take a look at the positives. The CIL plant lifted the production volume as the management promised. So we revise our full year forecast up by 5% to around 30,000 ounces. And also, the management decided to replace the old 3 leaching packs with the other 2 new leaching packs. So the leaching packs is like a bathtub that they will put all the ores into it and irrigate with solutions to dissolve all these ores to extract the minerals. So in 3Q, new leaching pack already started to operate. So the good thing of these new leaching packs is that they can leach the ores without removing the leftovers of them out of the pack. So it will help to benefit the operation by lowering costs and further improve the recovery rate. So each of these new leaching packs capacity was around 3 millions. So another new pack will commence operation in first Q next year. The negatives are that the tax expenses jumped this quarter, mainly due to the expiry of the tax exemption scheme. So previously, there was 100% tax exemption on the sale of gold dory bars. So without this exemption, the current tax rate is around 24%. So at the moment, the group is liaising with the authorities for the clarification on the tax status. So the outlook for CNMC Gold Mine is that the management will roll out multiple expansionary plans, including to establish an additional gold deabsorption and smelting facilities for the CIL plant. And also they will start to monetize the basic metals such as silver, zinc, and lead. It is expected to see the revenue contribution from this in the second half of next year. So another thing to be worth noting is that they are also considering to install a power line to power the whole so-called field, because currently they are using the diesel as the source of supply for power generation. As we knew that the diesel prices continue to go up, so it may help to lower the total operating expenses by installing this power grid. And the total capex of this power grid, it will is expected to be less than about $10 million US. So next I will pass on to Paul to talk about Asian Pay TV Trust.
Thanks, Kwang. Okay, I'll move on to Asian Pay TV Trust. They just released their third quarter results. Okay, in terms of the results, they actually raised our EBITDA post the results. But I think what hurt the share price, that almost 50% decline, was of course they cut their dividends. Used to be 6.5, they cut it down to almost 90% to 1.2 cents. Do note that they are still maintaining its 1.625, that there's still going to be one final payout, 1.625 for the third quarter by December. Okay, but anyway, going back to the results, actually it was more or less everything was in line. We actually raised a bit of our EBITDA because the revenue was a tad better than we had anticipated. The main positive for us was the broadband subscribers. They continue to gain traction, and in the third quarter, the 5,000 net gains was actually the highest quarterly increase in broadband subscribers since their listing. But as you can see from the red box here, the revenue was only, despite the growth in broadband revenue, was actually flat. The pressure they have is that the ARPU was down 5%. The reason for that is because in Taiwan they cannot price it too high because there's still competition, especially from the wireless operators, the mobile operators, that are offering unlimited broadband. They do not throttle your speed down, even though you can surf unlimited in that sense. Okay, then the other part of the negatives for us was again the pay TV subscribers, and ARPU is still falling. So as you know, this is the core part of the business, which is the basic cable TV, and that fell 6%. So that is actually the one that worries us the most. That's to shed more light. Since listing, actually, the pay TV subscribers has been pretty stable, but only beginning this year, we're beginning to see the subscriber numbers start to come off. Part of the reasons is because in the past, there was always a churn out in subscribers, but because of as they were rolling out, as they were removing analog, they were actually taking out a lot of so-called pirated content. Those households that were using analog pirated, so there was actually a lot of new net subscribers. But once that rollout started to end, then we begin to see very few new net subscribers, and instead you get the usual churn out of subscribers. But anyway, and another reason is not only the subscriber numbers are weak. You can see even ARPU was down 4%. In Taiwan, for them, there is a basic cable, a maximum price that they charge, which is controlled by the authorities. But the problem came about was that there was this negative publicity out of Taiwan that was having a price war out of Taipei. Sorry, that has actually nothing to do with them, but actually that created a lot of headline sensational numbers that caused them to actually have to give discounts on the ARPU. Otherwise, most times, the ARPU usually only falls because the authorities actually reprice it down the maximum level. Normally, they will price their cable TV at the maximum price. But anyway, just to move on to our recommendation, we update to accumulate. Technically, there's actually no change to our DCF valuations, but we're also cognizant that we brought down our target price more to the dividend yield. Because I think as they guide a 2-year DPU guidance of 1.2 cents, the price appreciation is actually going to be capped. And as a result, we are just benchmarking their dividend yield to some of the Taiwanese peers. But we're giving them a discount because they have a smaller franchise value. Because as you know, they're only a basic cable and broadband operator, where some of their peers, which is in our report, that these are the huge fixed line and also mobile operators. Just one final note, one of the reasons why they cut the dividends, of course, it was not explicitly mentioned. I think they were beginning to worry about their net debt to EBITDA cover. They mentioned that by year end, their net debt to EBITDA would probably hit 8 times. And I think this is probably hitting the limits of their debt covenants. Although there's a refi coming up and they will probably raise it back to 10 or so. But I think that is a worry for them, which in the longer term this is positive, but near term, of course, it's a major issue because they've always been paying out dividends from leverage. Okay, that's it for me. Move on to China Weekly.
Thank you, Paul. For China last week, the two main stories of the China macros is the government bans the kindergarten companies to form the selling shares, and the secondly is China's October's the M2 numbers. For government banning kindergarten companies to selling shares, there's 3 points you need to focus. One is social the government says the social capital can't be control the state-owned kindergartens. We analyzed because the kindergartens, the education is also part of the educations of the primary schools and the junior high schools. We say we analyze the list of policy may also apply for the primary schools and the junior high schools. Secondly, for the profitable kindergartens, there will be more requirement, and we say because of the higher requirements will cause the higher operation cost of the kindergartens. Thirdly, listed companies that shall not invest in the profitable kindergartens through the stock market financing. So we analyzed in the worst scenarios, the listed companies will defeature this kind of the kindergarten's asset. There is companies that have companies involving in kindergarten's assets in A shares, H shares, and the China company listed on US, especially for the RIB educations. They operated 306 preschools, and the revenues came from the kindergartens to account for the 71%. That's why ever since the policies released, the companies, the share price down about 15% in 1 trading days. Secondly is China's October's M2 numbers and the new bank rooms. China October's M2 numbers and the new bank rooms are lower than expectations. We think this is on part of the reasons is because of still in the process of the deleveraging. Also, the banks are tightening the credit. Because of the PBOC, they said they will adjust their MPA, also known as risk models for the banks. For now, the aggregate financings and RMB rooms, the growth numbers are still higher than the nominal GDP growth. We say because of the new MPA models, banks will be rooms will be more accurate, targeting to the small and mid-sized companies, to the companies that need more. So for the company recommendations, our Hong Kong research teams recommend Net Dragons. This is because of the industry perspective. The game approvals will be more released on next year's. Also, the educational website have been profitable. Hong Kong research teams put the earning per shares on 2008 expectations about 0.44 RMBs. For all Hong Kong research teams also recommend the HC Group. They say because of they have transactions business models from the B2C to B2Bs, there will be a new growth drivers. They put the PE ratios on 2018 to 22 times compared to the 5 years average 24 times. This week we are looking for the G20 meetings, also waiting for the China's to set down the date of the forced penalty sessions. Because on these sessions, the Chinese will release the more policies about reform and open up. I will move to the elements for the US weekly music.
All right, thank you. Now I move on to the US market outlook. So for the macro indicators last week, the core inflation rate year-on-year for October is up 2.1%, which is relatively stable, although it is slightly short of the estimates of 2.2%. The retail sales month-over-month for October rose about 0.8%, which beats the consensus of 0.5%. And industrial production is doing well because it beats the forecast by about 1.1%. Corporate-wise, Apple's suppliers, main suppliers, such as Japan Display, Lumentum, and Qorvo, reduced their financial guidance for the third quarter, citing that there is a weaker demand from smartphone makers. Although they did not say that Apple is the particular smartphone maker, but it is important to note that Apple contributes at least 30% of the revenue for each of these suppliers. However, we are still pretty positive on Apple because we believe that in the long run, Apple services will become the dominating revenue driver for Apple. Next, we also know that General Electric, the CEO of General Electric announced that they're going to reduce their leverage and to raise cash by selling its assets. The current GE debt to equity ratio is about 3.7, which is 4 times more than the industrial average of about 0.7. So it remains to be seen whether General Electric will be able to make good its shortfall, which is predicted to be about 20 billion by the year 2020. Some of the key indicators to be released next week will be the durable goods orders and the existing home sales. Last week, we have some investors that asked whether whether S&P 500 is overvalued or whether it is cheap. So we prepared a preliminary graph, and as seen from the chart here, you can see that S&P 500 is not very cheap because it is fluctuating between its standard deviation and its average. However, if you look at the FANG PE ratio, it is currently below the standard deviation, and you can say that maybe it is cheap for now. If you look at the S&P price to book ratio, it is much higher than its standard deviation. Last week, we also had some questions regarding whether there's a rally for the US stocks. So we look at some of the market breadth indicators. The first will be the accumulated advanced decline line, which is the blue line. So you can see that the blue line is increasing while the S&P 500 is trending downwards. So this may mean that the sellers of the S&P 500 is losing conviction, and that may mean that there could be a rally coming up. But if you look at the other market breadth indicators, such as the accumulated high-low line, you can see that it is slightly trending down, which is in the same direction as the S&P 500. Okay, next I'll move on to Paul for the Phillip musings.
Okay. Thanks, Edmund. Okay, just move on to the Singapore Weekly. Just in terms of the macro news, retail sales was stable in Singapore. I think nothing to shout about. It's about only 1.8% in September. More or less the same type of growth in last year. On Friday, we released the export numbers. Exports has been doing reasonably well in Singapore. It's actually up 8% in October. What has been helping exports in Singapore has been the chemical sector. It actually spiked up about 30%. Electronic exports are still weak, down 3.5%. This is probably the 11th month of contraction for electronic exports in Singapore. I'll move on to just some corporate highlights. We were at some property briefing yesterday. What was interesting was that one of the comments made was that the developers are rushing to launch projects because they worry of exhausting the market getting exhausted. So what were the comments made was that there's around 52 projects lined up in 2019 with a total units about 19,000 units. That includes one EC project. And just to get up some sense how the market is going to absorb, I think during the 2014-15 post TDSR, the primary sales about around 8,000. So this is quite a huge number of 19,000 compared to the usual annual take up of about 8,000. Then the other comment made was that the one hot project will probably be the EC project by Sumang by CDL. And also the other comment made on the property market was that initially buyers were holding back, but what has happened is that they were all watching at the recent land bids, but the recent GLS land bids, and what has happened is that actually the land bid prices has still been holding steady. So as a result, buyers that were hoping that the land bids come off, so that they were thinking using that as a benchmark whether property prices would correct, but actually because of the land prices being quite resilient, there has like one indication that the prices will still hold steady, at least for the near term. The other final comment was that pre-cooling measure, the take-up rates were healthy. Take-up rates about 40%. I think now post-cooling measure, any take-up rate about 20% will be considered a healthy for any launch because of the huge amount of launches that's coming out in the next 12 months. In terms of our bet, we again, I think this nothing new. I think we mentioned last week that we still think that there's probably going to be a positive meeting between presidents, Xi and Trump. What has happened is that, as you can notice, that Trump has been tweeting positive things, and also they are focused more on immigration. And always do remember that Trump is someone that he can reverse whatever he just said. I think, remember, as he was very hard on the Iran sanctions, but he has actually did a 360 and actually gave some waivers to many countries on the Iran sanctions. And also remember, a couple months ago, he was very hard on North Korea and did a 360 again. So we think that at least in the near term, there could be some headway on the negotiations between Xi and Trump. But the problem is, the fundamental problem is that US is the trade, even with this, even if there's something positive on this meeting, the trade deficit is not going to go away. I think with the strength in the US economy, the imports will still, the imbalance in trade will still exist, especially when you know that US is doing on this fiscal pump priming. Okay, but anyway, and the other bullet point is that so far all the results has been come out that has been released. I think in general, most have been disappointing, or at least met expectations, except for some commodity names. Okay, I think that's it for our review. If you have any questions, do please post them, and we will try our best to help to answer them. Thank you. Thank you for the questions. One question is that is cable TV in the sunset industry, will APTV be greatly affected by this? Of course, the cable TV in Taiwan is not like the cable TV here in Singapore. I think that is more likely like a sunset industry because of the so many OTAs, or like Netflix and even Walt Disney that's coming up with their own channel. But in Taiwan, it's mainly it's mainly domestic content that is popular, like those like news and even those entertainment shows and so forth. And like we mentioned before, they sell a package of 100 channels, and a lot of them local content. Out of the 100, maybe 2 or 3 is only free to air. So most of them are sold through cable TV. it is not sunset in terms of very steep decline, but it's already matured in that sense. And we think for this APTV, you can just think of it of a company where the earnings or EBITDA will probably slow to maybe mid single digit kind of growth, negative growth. And the only thing that can help APTV in the near term is if broadband has to really pick up strong. Then because broadband margins are I'm just probably 50% to 60% higher than cable TV, so that will be the one that can improve. In terms of the question, will APTV be greatly affected by it? It will just drag their like I mentioned, it's just this company is just going to grow negatively, mid single digit negative growth. But the management are still trying to grow the business. I mean, just that the outlook in the near term is quite challenging. Now I'll move on to the next question. Okay, thanks. We got another question. We'll just answer on behalf of Tara. The property counters have been badly hit recently. When or how would they move in the near future? I think it would still be very challenging. I think if you just look at the news flow that's coming out with so many developments being pushed out, I think there's still some downside risk because you're going to get a wave of negative news flow if those 50 plus developments were to really get launched, because I think the take-up rates are probably going to be pretty poor. I think the one that has been the most recent launch that had very negative response on paper at least, but I think they went very quiet, was the Woodley residence. I think that only a couple of units was taken up, although they didn't really mention much about it. I'm just worried about the onslaught of negative news coming out for property, especially for all these launches. Yeah, thanks. Give us a few minutes. We got a couple of questions. Hold on, please. Thank you.
Hello, there's a question on first read. What's the next support to accumulate? So even though the price has dropped, we still maintain our neutral call with a target price of $1.30, as you can see our reasons in our latest report on the receivables still aging, and the outlook from the sponsor side is not looking too great. And there's also a question on what CapitaLand has been doing to help the tenants for the retail side. So CapitaLand, as you know, a lot of their malls for the Singapore side is under CMT. So CMT, they have been doing some initiatives on the digital front, such as the Capital Mall Star Rewards. And for CapitaLand themselves, for Plaza Sing, if you have read their latest release in 4Q, just about 1 or 2 weeks back, they started this Nomad X, which is like some sort of a digital platform. So that's how CapitaLand is trying to bridge the gap between the online and offline space. And in China, you can, as I had pointed out earlier in my presentation, they're still seeing double-digit growth in tenant sales. So that's doing whatever they have been doing on the ground has been gaining very good traction.
Yeah, thank you for the question. So one of the question is, how much will the US market be affected by any news by the Mueller report? So I guess the Mueller report would likely affect, depends on the depends on the extent how bad or how negative the report will be. It will largely affect the US president. So if it could be that it will affect the US dollar going forward, and it could be a good thing for Asia, but it will affect the sentiments of the US market. Yep. There's another question on the breakdown of the FANG stocks on how expensive or cheap. We don't have the information right now, but we can share with you during the next sharing session. Yeah, for the stocks BNB question, we are currently working on it, and due to some technical issues. All right, if there's no more question, then we'll end this session. Thank you very much.